So now we are going to start with what is assertions. Okay. So people who are attending today, I believe you must have heard of the word assertions before, but you were not clear of what this word actually means. So today I'm going to teach you like how a person would teach to a LKG kid. Okay. So that will be the level of teaching today. So you will be able to easily understand. So when I Googled what is assertions, okay, whenever you don't know something, the first thing what you do is you Google it, right? So when I Googled what is assertions, this is the definition that I got. It was written that state a fact or belief confidently and forcefully. This is what assertions mean. That means what happens is that you would have already known that it is a responsibility of the management of a company to prepare financial statements. So it is a management responsibility to prepare financial statements, right? So what happens is that suppose we'll take the example of Reliance company. Suppose we'll take the example of Reliance company. Okay. And in that we'll take the example of Jio. Okay, we'll take the example of Jio. So what happens is that the management of Jio had given a financial statement, or the management of Reliance have released their financial statements. Okay, we'll take that they have shown their financial statement, that they had shown their trading account. They had shown their trading account. In trading account, you know that you will be shown sales, right? In the trading account, you will be shown sales. So what they have said is that usually they will give the information of current year also and previous year also. So they will give the information of current year also and previous year also. So what they have told is that in previous year, the Reliance company had made a sales of 4 lakh rupees. Okay. 4 lakh crores you can add. I'm just giving you an example. Okay, 4 lakh rupees. And in the current year, the Reliance has made a sales of 3 lakh rupees, suppose. Okay, 3 lakh rupees, suppose. So this is what the management tells us. So when an auditor is going to read the financial statement, or when any user is going to read this financial statement, they are going to see that yes, previous year the sales was 4 lakh, current year the sales was 3 lakh. Okay, now we'll take only this part, that current year sales is 3 lakh. Now you guys will answer me, what do you understand from this figure of 3 lakh? If I give you only the information that sales is 3 lakh rupees in current year, what is the information that you can derive from it? First information is that yes, definitely 3 lakh rupees sales has happened in this year. I'll give you one more example. The second, the sales which are being given in the financial statements is related only to Reliance, and the sales of 3 lakh is not related to any other entity. Or what else can you tell me from this sales? Like this, what other information are you able to derive from the sales? Can I get 1 or 2 answers so I can proceed? What is the management trying to tell us by putting the word sales is 3 lakh rupees? So now we are at the start. So now the time is going to be 3:10 p.m. Okay, at this point you have no clue what the Reliance company sales of 3 lakh is trying to tell you. Okay, by 3:45 you guys will be able to clearly tell me many things from this. Okay, so this is what is today's class going to be about. Okay, so what is going to happen is that when the company or a management writes that the sales is 3 lakh rupees for current year, from this what and all information can we derive? From that, what and all information can we derive, or what is the information the management is trying to tell us is only known as assertions. So this is what is known as assertions. The information that the management is trying to tell us from this figure of 3 lakh rupees of sales is what is known as assertions. See, now if you read, you will be able to understand. So there are a few assertions. So assertions can be of 2 types. Okay, not 2 types. Assertions can be told in 2 classifications. One is for P&L and trading account, there will be different type of assertions, or the things which management is trying to tell us. And for balance sheet, there may be different set of assertions which the management is trying to tell us. Okay, so what we are going to do as an auditor is that we are going to see whether the assertions that are given by the management is correct or not, is what we are going to see here. Okay. So now we are going to start with the P&L account. Okay, so until now I'll just give you a recap of whatever I have told you, a summary. So what is assertions? Assertions is when you see a financial statement. It may be a trading account, profit and loss account, or balance sheet. And when you take an item out of it, it can be any item. From balance sheet you may take asset, from balance sheet you may take a liability, or from the P&L you may take an income, or you may take an expense. Like that you may take any, or you may pick any item from the financial statement. From that item of financial statement, a management, when it writes a figure of 3 lakh rupees or 4 lakh rupees or whatever it is trying to tell us a few things. Right now you don't know what it is trying to tell, but I'll teach you what it is trying to tell. Okay, and as auditor you have to see whether whatever the management is trying to tell us from this figure, is it correct or not. So whatever the management is trying to tell us is assertions. That is known as assertions. Okay, now when you see this, now when we are going to start with this, you will clearly understand what it means. Okay. So first is, now we are going to start with P&L assertions or income statement assertions. P&L or income statement assertions means what the management is trying to tell us from the profit and loss account or from the income statement is what we are going to understand. Okay. So these are the assertions. The assertions here is occurrence, completeness, cutoff, measurement, presentation, and disclosures. So related to income statement, there are 5 assertions. Okay, now we'll start with the first assertion. First assertion is called the occurrence. Okay, so what does occurrence means? Here they have written, see, occurrence means the transactions which are recorded in the financial statements have occurred. These transactions have occurred. That means if you have recorded a sales of 3 lakh rupees, it means the sales of 3 lakh rupees has occurred. Okay, and it also relates to this entity only. That means the sales of 3 lakhs is relating to Reliance only. It is not relating to Tata or any other company. If Reliance in their financial statements have written that we have made a sales of 3 lakh, that means Reliance has only made the sales of 3 lakh. Okay, and relate to the entity. This is the first assertion we can pick up from the figure of sales 3 lakh. Okay, what is the second assertion? The second assertion is relating to completeness. So what does completeness means? Completeness means all the transactions that were supposed to be recorded have been recognized. That means in the sales of 3 lakh, there is no other sales that you have missed. Okay, you must not have missed any sales. All the sales which had occurred should have been recorded. That is what is completeness. Complete information you should have given about the sale. Next is cutoff. Cutoff means it has been reported in the appropriate period. That means in the sales of 3 lakh is the sales of current year only. Previous year sale you would not have been recorded today, or next year sales you would have not recorded today. This sales of 3 lakh is recorded in the has happened in the current year only, and you have also reported it in the appropriate period only. So we have read 3 assertions until now. So what are the 3 assertions? First is that it has occurred, occurrence. Second is about completeness. Third is about cutoff. Okay. Fourth assertion is about measurement. That means has it been accurately measured? That means has appropriate amounts be returned. Okay, 3 lakh means it should be of worth 3 lakh only. Okay, and related to that, if you had any tax or anything which you had to deduct, you would have deducted it. Okay, any adjustment like from this 3 lakh, it is if 3 lakh figures is given in the balance sheet, it means that from this sales return has already been deducted. So if there is any adjustments related to the amount, all the adjustments have already been done, and it is measured properly and been recorded. Okay, so someone has asked me a doubt on cutoff. Cutoff means the current period item. Can you please erase this, whoever had drawn that line on the screen? Okay, so cutoff means that in the appropriate period only you would have recorded it on. Suppose what had happened is, see, I am the company. Okay, I had made a sales to a vendor. Okay, so we had sent a few samples to the vendor, and the vendor told that We had sent a few samples to the vendor, and the vendor told that in the next year I will buy the item. If the vendor suppose says that I'm going to buy the products from your company, but I'm going to buy it in next year only. So what I do is that I'm a foolish employee, okay? I'm a foolish employee. So what I do is that what I do is I think that anyway next year sales is going to happen only, right? So he has given us assurance that next year he will take a product from the company. So what I do is that to make sure that my profit is seen more in the company, what I do is the next year assured sales whatever are there, this year itself I book it. Okay, so this has actually not happened in this period at all. It is going to happen in the next period, but this period itself I book it. Okay, to show my profit more. Is this correct or not? Divakaran, you tell me. Have you understood what cutoff is? So this is wrong, right? So you should not do. So whatever income or expenses are there relating to the appropriate period only, you have to record. Divakaran, is it clear? Yes. Okay. So next I told you about measurements. I'm going to give you 4 to 5 more examples on these assertions so you will understand better. And finally is regarding the presentation and disclosure. So if there were any disclosures that you had to make about the sales, all those disclosures you should have made. This is what they're trying to say here. Okay. So we have read about 5 assertions relating to the income statement. Okay, the first assertion was occurrence, that the sale has occurred in this period and relate to this entity only. Next is completeness. Completeness means whatever sales you had made, have you recognized or recorded all the sales which were made? You must not have omitted anything. Okay. Third is cutoff. Cutoff means in whatever period the sales had to be made, in the appropriate period you had recorded the sales also. Fourth is measurements. That means whatever adjustments have to be made to the value of sales related to sales return or anything like that, you have made it properly and the sales has been measured properly. Fifth is presentation and disclosure. That means that whatever disclosures you had to make related to the sales, you had made it properly. Okay. So is this 5 assertions clear? Now I'm going to take a next example, but before that, do you have any doubt in this 5 assertions? Can I get at least 10 replies? So now I'm going to tell you another example. Okay. Yes. So now we are going to see an example from the textbook. Now we have understood it in the reference of the sale. Now we are going to take the example of employee benefit expenses. Okay, employee benefit expenses we are going to see. So first assertion is occurrence. So what does this trying to tell you is, suppose if in the financial statement you have something written known as employee benefit expenses and you have a value written next to it, so this will try to tell us something. So this part will try to tell us something like how sales value of 3 lakh was trying to tell the user or the person who is reading the financial statement a few things. So the same way the employee benefit expenses would be trying to tell you something, or rather the management is trying to tell you something by writing that employee benefit expenses is so much. So what are those things which the management is trying to tell here, or what are the claims the management is making related to it, is what is known as assertions. So now we are going to read the assertions. Okay. So employee benefit expenses, first occurrence. So here they have told you that, see, employee benefit expenses has been incurred during the period in respect of the personnel employed by the entity. That means whatever employee benefit expenses you have incurred as a company, it has been incurred in the during the period only. That means in whatever period this financial statement was made, suppose if it's for 2021, then this employee benefit expenses, what you have recorded or shown in the financial statements, is also related to 2021 only, which has been incurred during the period. And this whatever you had recorded, it is in respect of the personnel employed by your entity only. You should not have recorded employee benefit expenses of some other entity. Okay. Yes. That only they have written here. It must not include the cost of any unauthorized personnel. That means some other personnel's what do you say, the cost or expense you must not have recorded here. So occurrence means that yes, it has actually occurred in this period and this relate to our entity only, to our entity's employees only. Okay, so that is the first thing, occurrence. Second is completeness. That means the employee benefit expenses in respect of all the personnel have been fully accounted for. So related to every personnel for whom you gave this employee benefit expenses, you have correctly recorded it in your books of accounts. That is what, not in books of accounts, that you have shown it in your financial statements. That is completeness. Third one is cutoff. Cutoff, they tell you that you have reported it in the appropriate period. That means the employee benefit expenses during the period relates to the current accounting period only. Past year's employee benefit expenses or the upcoming year's employee benefit expenses, you should not record it in this year's financial statements. So whatever expenses were relating to 2021, the current year period's expenses only are recorded here. Next is measurement. So in measurement, that means it whether the employee benefit expenses has been measured or calculated accurately. Suppose you had any adjustment such as tax, that is TDS, tax deduction at source. Have you done it correctly and reconciled and accounted for? Suppose you had an expense of 50,000, okay, and in the balance sheet you had, or in the balance, not in the balance sheet, in the P&L you had shown it as 30,000. That means between this, the TDS, whatever was to be deducted, you have deducted it properly. Suppose you actually, what you had to deduct was 20,000, but you know what you did, you just deducted 10,000 and showed it as 40,000. What you paid as TDS was 20,000 only. But just because you thought that the profit was coming too much and you want to reduce the profit, you only accounted 10,000 rupees and increased your expense. Like this and all you must not do. So whatever is the correct amount, that only you have to properly measure and recognize it. Okay. And the last point is presentation and disclosure. That means what and all you are going to disclose relating to the employee benefit expenses, that you have to see whether it has been fairly allocated between whatever it was relating to operating expenses, that means relating to manufacturing or producing department, for them properly. If suppose the expense was 30,000 rupees, okay. So if for the production department it was relating to about 10,000 or 20,000, and next for the administration department it was 5,000, and the remaining department it was remaining one second guys, this was for production department, right? And the remaining 5,000 for the remaining department. Like this, if you had the employee benefit expenses relating to different areas in an entity, has it been classified properly and shown in the financial statements? See, whenever you write expenses, you know, suppose if you're writing employee benefit expenses, you have to classify and also tell them. If you just write bluntly 30,000, down in the notes or in the disclosure areas, you have to disclose for operating expenses how much it was, for the administration people how much it was, for the cost of personnel relating to self-constructed assets how much it was. So like this you have to disclose and show it separately. So have all these disclosures which had to be made, where it made properly or not. So these were all the assertions relating to income statements. Okay, I hope the assertions relating to income statements are clear. Okay, now I'm going to give you one thing. I'm going to give you one example. Now you guys will tell me what is the assertions related to that. Okay, what is the assertions related to that? Suppose now I'm going to give you assertion of purchase 5 lakh. Now, as an auditor or as a user of financial statement, what are you able to assert? Take the assertions from this, you have to tell me. If the purchase is 5 lakh, the first assertion is, you can see, first assertion is occurrence. What are you able to tell me from the purchase of 5 lakh? Can you please tell me? First, let's start with occurrence. What are you able to tell me? What are you guys able to tell me? Can someone answer? Purchases are related to that entity. Very good. Purchases of 5 lakh took place. Purchased goods worth 5 lakh. It relates to that entity only. Very good. So occurrence, everybody is right. Next. Yes, correct. Correct. Okay. Next is completeness. You have to tell me about completeness. Tell me about completeness. What is the completeness? How will you be able to relate to the purchase of 5 lakh? What is that assertion telling you? Purchases were fully accounted. Very good. Purchases were completely recorded and nothing was omitted. Very good. Very good, guys. Okay. Very good. Next assertion you guys will try to tell me. Next is cutoff. Tell me about cutoff. That these purchases relate only to current year. Very good, guys. Okay. 3 assertions are over. It is related to the financial. Yes, correct. Financial year. Okay. Next, measurement. Tell me about measurement. Net purchases, that is purchases minus purchase return, have been done. Okay. Trade discount has been reduced from purchases. That also you can say here. Any adjustments that were to be made have been made and the purchase have been correctly accounted, have been recorded accurately. Okay, very good, guys. And the final assertion is regarding presentation and disclosures. Okay, someone has told me for measurement, net purchases are recorded. Very good. Measured accurately and adjustment are reconciled correctly. Okay, very good, guys. Last is presentation and disclosure. Okay, so whatever disclosures you have to make relating to purchase, that you can make. Okay, whatever is important to make, that you can make. So these are the 5 assertions, guys. Okay, so what will happen is in this chapter number 9, which you are studying right now, in this chapter number 9, what is this chapter about is that like this in same way, a lot of P&L items you will be given in this chapter. For all those P&L items, using these assertions, you have to write what information are you able to tell about it. Okay, I'll just give you the meeting is going to end soon, so before that I'll just show you. See, this assertion is regarding to the sale of products and services. So regards to sale of products and services, what are the things that you will be able to understand when you study the financial statements is what they have told you. See, in the brief description and audit procedures. This is what is given. If you read this, you will be able to understand. Okay, see, I'll just give you an overview. Okay. See, so recorded sales represents goods shipped or services performed during the period. So during the period only it has been done, the sales. Okay, and then all sales made during the period were recorded, and then no understatement or overstatement of sales have been made. Then all the sales are accurately measured, okay, as per applicable accounting standards, and correctly journalized, summarized and posted. Then required disclosures related to sales have been made. Okay, so see, this is the brief description. So even if you read it by yourself, you must be able to understand that chapter. So I'm trying to tell you this. So in the brief description, in this box of brief description, they will tell you about what are the assertions that you can make. Okay, what are the assertions that you can make from sales? And in this audit procedures, what they will tell you is that, suppose if you have made an assertion that all these sales have been performed during the period only, how are you going to check that assertion? Whether that assertion of sales have been performed during the period only, is it correct or wrong? That you have to check. Yeah, by a few audit procedures they have given you here. Yeah, you can see. You have to check whether a single sales invoice is recorded twice or cancelled sale invoices is being recorded. So all these you must check. Then only you will be able to confirm this assertion of that sales has been performed during the period. Okay, so this is what the chapter is about. Okay, I hope the chapter 9, the overview of the chapter 9 is clear to you guys. Okay, so in this chapter like this only many boxes will be given. In left hand side it will be given whatever assertions are made, and on right hand side how can you check whether the assertions are right or wrong. By doing the audit procedures they will give you about that. So like that each item of financial statement they have taken in this chapter, and they have told you what are the audit procedures you can perform to check whether the assertion that have been made is right or wrong. Okay, guys. So until now, income statement, I hope everything is clear. Can we move on to balance sheet items assertions? So income statement, 5 assertions: occurrence, completeness, cutoff, measurement, and presentation and disclosure. Yes? Can we move on to the balance sheet assertions? Okay. So in balance sheet captions, first I'll just give you an overview and then we'll read it in detail. So here also you have 6 assertions. The assertions are existence, completeness, then you have cutoff, valuation, rights and obligations, and presentation and disclosure. First we will start with existence. Existence means suppose what happens is that in the financial statements they have shown us a land. Okay, they have suppose shown us a land of 30 crore rupees. They have shown a land of 30 crore rupees. Okay, that means in existence what the auditor has to check that if the management says that we had a land, we have to check whether it is existing or not. Okay, in existence, so what happens is whenever you will read a financial statements, if you see that a land of 30 crore is given, that means you will believe that in reality this 30 crore land is actually existing. Okay, the existence must be there. If in the company they have given that they have a plant and machinery of 5 lakh rupees, actually the plant and machinery of 5 lakh rupees must exist. Okay, so that is the existence existence assertion. Okay, okay, so it means that whatever assets and liabilities are given by the entity, it must exist at the end of the period. So that is what they are trying to tell in the existence assertion. So how will the auditor check this? So if the management says we have a land, the auditor must check whether the land is actually existing or not. How will he check it? He can do physical verification. Okay, suppose if they have a liability of loan, and if they tell that they have a loan of 30 crore rupees, at such case also it means what assertion the loan is trying to tell us that the company actually has a loan of 30 crore. Now what the auditor has to do, the auditor has to check whether the company actually has a loan of 30 crore or not. Whatever the management is trying to tell you, the auditor must just perform audit procedures and check whether all these assertions are correct or not. Suppose if the management is telling you that they have taken a loan of 30 crore, what the auditor must do is he must check whether actually the loan is existing or not. For that he can check the agreement which is supporting to the loan and verify. Next assertion is completeness. In completeness, they tell you that all the assets, liabilities, and equity balances that were supposed to be recorded have been recorded. That was supposed to be recorded have been recorded. That means whatever thing, each and everything should be disclosed. There must be no omission, and the auditor has to check this. So this is what they are trying to tell in completeness. That means whatever you had to record, have you recorded or not? Okay. Next is cutoff. Cutoff means all the assets and liabilities which you have reported are in the appropriate period only. That means if this year you have bought a land of 30 crores, you must not show it next year. In the appropriate period, that is in the current year itself, you must show that. Next is valuation. Valuation means whether the assets and liabilities, everything have been valued correctly or not. Suppose if you take the example of inventories, you have a AS2 tells you that you have to value lower of cost or net realizable value. That is nothing but cost or NRV, whichever is lower. So according to that, whether have you correctly valued your assets and liabilities? Okay, you have to see. Next is rights and obligations. Rights and obligations means if I have a asset, that means do I have a complete right over it. Now suppose in my financial statements it is written that I have a land of 30 crores. That means that the company, what it tries to tell us is that, what assertions it is trying to tell us is that the company has all the right over this land, right? This is what the management is trying to tell us by writing land 30 crores in their financial statement. Now as an auditor, we have to check whether this right is existing or not, whether the company actually has a right on this land or not. Okay, that is what they have told here. Next, presentation and disclosure, that all the things which you had to disclose, have you disclosed it properly or not? Whatever you had to present, have you presented properly or not? Okay, this is what is given here. So these are all the assertions relating to balance sheet. Now I'm going to take an example of inventory, what is given in the book, the inventory example itself, and now we are going to understand using these assertions. Okay, now you guys should, without reading, you have to tell me what is inventory trying to tell us, what is the existence. Tell me, if I write inventory of 2 lakh rupees and there is assertion of existence, what is it trying to tell us? That inventory actually exists. That means in the company, if you go and check the stock, or if you do physical verification, the inventory is actually existing. Very good, guys. Stock of 2 lakhs exists. Very good. Okay. Next is completeness. Inventory of 2 lakh exists at the year end. Yes, very good. Period end is very important there. Okay. Period end is there because during the year you may have 5 lakh of inventory, 4 lakh of inventory, or whatever it is. But financial statements are made according to the end of the year only. So if in financial statements they have written inventory of 2 lakh, that means at the end of the year the inventory was 2 lakh rupees, closing balance. Okay. Okay, very good, case. Next is completeness. Here what they try to tell you is that what had to be recorded, which was belonging to the period, has already been recognized. So stock value is fully recorded without any omissions. Very good. So here they have given you another point of view. They have told you that the inventory is there, units held by the all inventory units held by the entity, and it should have been recorded and recognized, all that you have read. Okay. So if inventory is held by any third party on behalf of the entity, has been included as a part of inventory. So what has happened is that since you were not having a space in your godown, so in your godown you were not having space. So what you did was, in a third party's house, you kept all your other inventory. That means now this inventory which is kept at the third party's house is also your company's inventory only, right? So that inventory related information also you should have recorded it properly. So that is what they are trying to tell you. Whatever is related to the entity and whatever should have been recorded should be recorded. Yes. Next is cutoff. Likewise, inventory which is held by the entity but belonging to others to be excluded. Very good, very good. Inventory value is pertaining to the current financial year. Okay, you are telling about cutoff, right? Okay, you guys have moved to the next point. I was thinking, how is it related to the last point? Okay. Yes, very good. So inventory balance does not include any element of next financial year. Suppose you are thinking that next year I will buy an inventory of 1 lakh. Will you record it this year? No. Only if you have the inventory of that much, you will have to record it. Okay. Valuation. Valuation. You guys tell me. Already I told you that you have to value the inventory correctly as per AS2, cost or NRP, whichever is lower. They have told us a few other things also. We'll read through that also. Any cost that could not be reasonably allocated to the cost of production, example, general and administrative cost and any other abnormal wastage, has been excluded from the cost of inventory. So if you had read this in costing, you would have known. So relating to that inventory alone, you must put the cost there. If there is some kind of abnormal wastage, you must reduce that amount. Only the normal loss amount you must include. And also If there was some expenses which was relating to general and administration costs, that also you must exclude. Okay. And whatever acceptable valuation basis is, whether FIFO, weighted average, or LIFO, or whatever it is there, according to that only have you properly valued or inventory, you have to see, because the valuation in such case will change, right? So all these, whether you have taken into account, you have to see. Next is rights and obligations. Here, rights means the company has right over the asset, or if it is liability means whether the company is the one who is that who is responsible for obligating that liability, you have to see. So in case of inventory, the entity owns and controls the inventory recorded in the financial statements. You have to see whether the entity is the owner, and also he has complete control over the inventory. That means complete right over the inventory. Any inventory held by the entity on behalf of another entity has not been recognized as a part of inventory of the entity. So in such case, the rights will not be with us, right? This point, same point we saw somewhere else, I guess. Yes, okay. So whatever is relating to that entity only, on that inventory only, our entity will have the rights. Okay. Next is presentation and disclosure. In that they tell you, they have given you about employee benefit expenses, okay, and they also given you related to related party transactions. Okay, this if you give it a read, you will understand presentation and disclosure. The same thing only they have given you. So relating to balance sheet, 6. Existence, completeness, cutoff, valuation, rights and obligations, presentation and disclosure. Okay. So in this class, today we have studied about, so that's it guys. So today we have studied about what is assertions. So assertions was about what management is trying to tell you. Now let's go back to the definition and understand. So company's management makes some implicit or explicit claims by showing it in the financial statements. So whether that is correct or not, or what are the things management is trying to tell us, is what is known as assertions. And whether the assertions are correct or not, the auditor is going to check by applying the auditing procedures.